Everybody. Welcome to the Wealth Lounge again. I'm here today with Nathan Sweeney. He's Deputy CIO of Marlborough Multi-Asset Funds. Marlborough is one of our key partners. We've been dealing with them for many years. They're a 30-year-old organization, specialists in active fund management. And we've been really impressed by their performances and the way they've handled funds recently. And really their knowledge and expertise is truly amazing, especially at the moment with all the volatility going on. We very much rely on good, solid, active fund managers to help our clients through this situation and make sure that their portfolios are still, being looked after. So I really brought Nathan on for a couple of reasons. Firstly, I was to speak about how Marlborough are taking their approach with regards to what's going on in the world. And then secondly, I want to touch briefly on bonds. So Nathan, welcome to the Wealth Lounge. And
thank you for having me.
No worries at all. So yeah, challenging times. I want to just get your feedback in terms of what's happening globally. Obviously, there's a lot going on. We've got supply chain issues. There's the escalating issues with Ukraine. Inflation, interest rates going up, the effects on the bond market, which we're going to touch on briefly a bit later on. So how is Marlborough? What's their approach at the moment? How are you navigating what's going on?
Yeah, so I think if you think about the environment right now, the question is it a challenging environment for active managers? So I think when I think of active management, it's a full-time job. So there's always opportunities, there's always challenges. With my old boss, used to actually highlight that point. She used to say that irrespective of the market environment, you will always have opportunities in markets. And if you think about what's happening today, we definitely have more volatility in markets. And I think this episode of volatility, it feels abnormal for a lot of people. And that's basically because we haven't had volatility for a long period of time. And that's because central banks have been very much supporting markets, underpinning markets. They've called it the Fed put. And because of that, you had very low levels of volatility. And what you're seeing now is that volatility has returned. But if you actually look at some of the long-term graphs of volatility going back 40 years or even longer, the level of volatility which we're witnessing today is actually quite normal. It just feels abnormal because we haven't witnessed it in a couple of years. So I think for active managers, generally they like volatility because it creates more opportunities. And then secondly, it really separates out good and bad companies. Because over the last couple of years, we've had kind of a rising tide. Everything has been going up, irrespective of the company type. And I think if you look at the recent earnings reports that have been coming out, you can see that companies who are doing well are being rewarded. So you saw Facebook coming out with their earnings recently. This is surprised with the number of new subscribers that they've had. And therefore, you saw the share price moving up quite strongly on the day. I think it was up close to 18%. On the flip side of that, you've got Netflix, company which disappointed. So they saw some losses in subscriber numbers, and as a result of that, the share price got hit pretty hard. So as an active manager, you're very much focused on fundamentals. So you're looking at what companies are doing, which companies are good. So this environment tends to be better for kind of the active management style.
Do you think, obviously, back end of last year, prices were really inflating and obviously we weren't sure where the top was going to be. Had we reached the summit, we'll be going beyond. And I guess, obviously, there was a correction, and then following the correction, we had this whole crisis with Ukraine. Do you think prices across industries have reset to realistic levels, or do you think do you think that hence we have an opportunity now to go back and buy, or do you see potentially more on the downside with certain industries?
Yeah, so if you think about the market is always trying to forecast 6 months ahead.
Right.
Say the forward discounting mechanism. So the market is trying to anticipate what interest rates will look like in 6 months' time. So in December, we had obviously inflation coming through at higher levels throughout the course of last year. And in December, the central bankers, specifically the Federal Reserve, which is the US central bank, they came out and said inflation is a problem. And leading up to that point, they were less concerned about inflation. So that was the material change in language from the central bank, which actually changed the market's view on pricing, what price you should pay for assets. And the reason that's the case is because if the central bank increases interest rates, generally that impacts the financing for companies. So companies have to borrow to grow, to finance their growth. And if interest rates go up, their cost of financing increases. If the cost of financing increases, then the valuation or the money that you would pay for that company, that changes because the cost is different. So what you've had over the last couple of months is essentially markets digesting what higher interest rates mean for the prices that we're paying.
Right.
So as a result of that, you have seen a correction in some segments of the market. So companies which generally rely more on financing, so companies which are looking to grow over a very long period of time, growth companies, they sold off more aggressively. And fixed income, which tends to perform when equities are selling off, it tends to be negatively correlated. Fixed income actually sold off as well. And that was a big concern for markets because that tends not to happen. But the reason that was happening is because we're expecting interest rates to go up, and therefore those bond prices have to go up too. But I think that's largely priced in now. So the expectation on yields and where they get to, it looks like that's priced into markets.
So following on from that point, fixed income, obviously, people are very reliant on within their portfolios. When they look at caution, they look at fixed income, they look at bonds. Given what's just happened, the yield curve is now inverted. Well, we saw an inverted yield curve. Short-term bond prices shot up 14 to 16 bips, I think, for 2 to 5 year bonds, and the 30-year bonds, the long-term ones, started to drop off. Now, that's not a great model for someone that's approaching pensions. They've got a cautious, heavy portfolio. Do you think it's a time now to rethink what we classify as caution, or do you think this is something that will settle back into the original format and will carry on as we go ahead? I mean, we don't have to move away from bonds, to kind of fill our caution for future purposes. Do you think that's the case, or?
Yeah, so I think you're right. A lot of people have been questioning the fact of whether this is the death of the 60-40 portfolio. So the balanced portfolio, which would have 60% in equities and 40% in bonds.
Hello. Sorry, I lost you there briefly.
Yeah, I'll go back and just cover off that question.
No worries.
So I'll take it from the top. So yes, I think you're right on that. A lot of people have been questioning whether the 60-40 portfolio, so 60% invested in equities, 40% in bonds, whether that portfolio is dead. Is that strategy no longer working? And actually, if you look back at history, you will have seen that over the last 40 years, there have been about 12 episodes in markets where you've seen both equities and bonds selling off aggressively.
Right.
And it's actually normally when central banks are looking to raise rates at a very fast pace, which is happening today.
Yeah.
So what the market is doing is taking that information into consideration. Bonds are selling off because you're expecting interest rates to rise. And equities are selling off because the financing for some of those companies is going to increase. But that tends to happen over a very short period, i.e. a quarter. which has just happened.
Yeah.
And if you actually look at a 60-40 portfolio, on average, when you get those 5% declines, on average, 5% declines, which has happened, as I mentioned, 12 times, over the next 12 months, you tend to get on average a return of 11.4%.
Right.
And that's looking at 40 years of data.
Right.
So the point being that I do think that bonds have priced in these rate rise expectations. And actually, you now are at a point where the inflation, which has been the main cause of this, is inflation at a point where inflation could fall.
Right.
So why would I say this? So if you look at the inflation data that came out recently from Spain, it unexpectedly surprised to the downside.
Okay.
So one of the key things which has been feeding through into inflation has been oil. So the price of oil, because it's gone up from very low levels last year. In March, it hit $125 a barrel. If we look at the average price of oil throughout March, it was $108 a barrel throughout the whole of March.
Yeah.
If we look at the average price of oil throughout April, it's averaged about $100, so it's now cheaper. Right. So that will feed through to the next reading we get for inflation data.
Okay.
So that's the key thing we need to focus on, because that's been one of the key inputs or drivers of inflation. But I do think that there are other areas which we need to monitor, and that's food prices are rising, so that will impact inflation. And we're seeing increased supply chain disruption due to new lockdowns related to COVID in China, which is yet to be through. But I do think that inflation is at a point where we're likely to see it softening. And that means that central banks will not have to increase interest rates as aggressively as they've been talking about. And that's a key difference, because they've been talking about raising rates and they're only beginning to do them. So all these rate rises that they've been talking about are now priced in. And if they don't actually raise them up to those levels, that will be good for equities and it will be good for bonds. And
I guess any talk from central banks just sends jitters through the markets whenever those are announced. So
exactly.
And then we see sell-offs as a reaction. Yeah. So there is some optimism out there. Then hopefully that we'll see inflation coming back down, and bonds still should remain moving forward a good place to be within cautious as part of cautious portfolio's.
And the other thing to highlight is that bonds are now at much higher levels. So the yields you can get on a 10-year is close to 3%.
Yeah.
So it creates an attractive opportunity for an investor, because you can get 3% income or 3% dividend from investing in bonds. Yeah.
Very true. And would you say someone that's, say, approaching retirement with their pension fund, say £500,000 pension fund, heavily and obviously in bonds, should he remain in that, or do you think there are other things that he could look at or should look at to kind of beef up the caution?
Yeah, so I think if you're looking at portfolios, there's obviously lots of ways to invest, and diversification is obviously the best approach. So we would always advocate having a mix of asset classes. So even if you're invested in a cautious portfolio, yes, you'll have fixed income in there, but you're going to have equities in there too. And that will just give you a broader spread. So not only are you getting diversification at an asset class level, you're getting diversification at a regional level, because you have exposure to different, regions. So US, Europe, Asia, Japan, etc. Different funds, different stocks, different styles.
Exactly.
But I also think there's some areas which you can add to in times of uncertainty. And for us specifically, one area we've added to is gold.
Gold,
and gold will tend to do well in an inflationary environment, or be an environment of uncertainty. And actually, it's one of the asset classes which is positive year to date. It's doing well. Other ways of thinking about it is, if you are getting exposure to fixed income equities, you can get exposure in more defensive ways. So if I think about equities as the first example, one way we have been doing that is by buying more funds with an income focus.
Right.
So this is investing in companies whose earnings tend to be very stable. And because of the stability of the earnings, it enables those companies to pay out a consistent dividend.
Yeah.
Because the company knows we're going to earn X this year, it'll probably be X the year after. So we can pay out this much of our, revenue as a dividend.
Yeah.
So those kind of stalwarts, steady Eddie type
industry,
companies tend to be a good place to invest in times of uncertainty. So we've been increasing our exposure to income funds generally across the board. And then within fixed income, so if you think about bonds, there's different types of bonds you can invest in. You can invest in government bonds. You can invest in bonds issued by companies, corporate bonds.
Yeah.
And within corporate bonds, you can invest in bonds issued by companies which are perceived to be safe, investment grade corporate bonds, or high yield, where there's a higher level of risk, but you're being given a higher level of yield. So we've been avoiding the riskier segments of bonds. So we have no exposure in high yield. We've got no exposure in emerging market debt.
Yeah.
And the majority of our exposure is through government bonds and investment grade corporate bonds. But within that, we've reduced our exposure to interest rate sensitivity, or duration, as they call it.
Yeah.
So basically, that's just the length of time you're holding the bond for.
Right.
And if the bond is paying X in terms of a income or yield, and interest rates are rising above that level, then that bond's price will fall because it's worth less because you can
exactly
money in the bank.
Yeah.
So we're buying bonds who have a short term, short duration, because it means that once that term ends, you can then buy the new bond with a higher level of income above bank rates.
Yeah.
So that's how we're thinking about it. It's definitely more defensively positioned across portfolios.
Right. Okay. Well, it's good to know there are options out there. We do have choice, and that there is some optimism out there as well, despite all the things that are going on. I think the fundamentals are still in place, the strong fundamentals. But as you said, it's that we're going through a patch, which has happened before. So I guess we shouldn't panic and just stay where we are and stay focused on getting through it and not making knee-jerk reactions.
It's important to remember the benefits of long-term investing.
And
I think it's human behavior to react at the point where the noise is loudest. So you're reading all the information in the newspapers. That tends to happen after the event, after markets are sold off. The whole premise of investing is to buy low and sell high. Not do the opposite. So you tend to find that investors will sell at the low point and then buy back in at the high point. So it's more about understanding the fundamentals of investing, and
that's a constant.
If you miss those best days in markets, and so often what will happen is the biggest falls in markets will be followed by the biggest one-day rises. So the biggest rises. So you really have to keep a cool head when you see all of the news press coming.
And I think that's a very key point, that the fact that the news starts to get out there after the event. So when people start to go in and react to that, by the time they have reacted, it's too late. It's already affected their portfolio. So there's no real point to go in and try and do things when things should, if we go back, look back at history, things should naturally rebound and recover again. Great. Well, thanks very much indeed for that, Nathan. I really appreciate your time. Be lovely to have you on again for something different. I've got loads of other things I'd like to ask you, but we'll keep it within this sort of time slot for now. But thanks very much again, and look forward to having you back on at some point soon.
Okay, thank you very much for having me.
Thank you.